This company sells jet engines, and sometimes it sells them at a loss. On purpose. Because the engine was never the point. The real business is what comes after, decades of servicing that engine, overhauls, shop visits, spare parts, on the largest installed base of jet engines on Earth, more than 45,000 of them. The engine is the razor. The aftermarket is the annuity. That company is GE Aerospace. And last quarter it beat on revenue, beat on earnings, and raised its full-year guidance across the board, and the stock fell 4%. Because one number cooled. 3 months ago, orders were up 87%. This quarter, 17%. So is the annuity cracking, or is the market reading the wrong line? Let's run the numbers. Start with what this company is, because it's brand new in its current form. In 2024, the old General Electric, the sprawling conglomerate, split into 3. What's left here is the crown jewel, a pure-play jet engine maker. It runs in 2 parts. Commercial engines and services, the big one, builds and services the engines on the planes you fly, largely through CFM, its 50-50 joint venture with France's Safran. And defense and propulsion technologies, military engines and advanced propulsion. The flagship is the LEAP engine, powering a huge share of the world's newest narrow-body jets, the Boeing 737 MAX and the Airbus A320neo family. This is no longer a conglomerate. It's a focused engine company, and that focus is the whole story. Now the heart of it, the most beautiful business model in industrials. A jet engine isn't bought once and forgotten. Over its 30-year life it must be inspected, overhauled, and repaired, again and again, and every one of those shop visits needs GES spare parts and GES labor. That's the aftermarket, and it is enormously profitable. So GE will sell a new engine cheaply, even below cost, to win a spot on an aircraft. Because once its engine is on the wing, GE owns 30 years of servicing almost no one can take away. Here's the scale, of a backlog above $210 billion, roughly $170 billion is services, work already committed, not engines still to be sold. The razor is sold at a loss, the blades pay for everything. And the timing right now is extraordinary. Because Boeing and Airbus are behind on new jets, airlines are flying their existing planes, and existing engines, harder and longer than planned. Older engines need more frequent, more expensive shop visits. Look at what that's doing, spare parts revenue up more than 25%, internal shop visit revenue up 25%, and shop visits on the LEAP engine specifically up more than 50%. It's the same tailwind that lifts helmets, blades and HEICO's parts. The longer the world's fleet stays in the sky, the more those engines come in for service. The new jet shortage is, quietly, a gift to the aftermarket. So how does that show up? In the June quarter, reported in July. Revenue rose 21% to $13.3 billion. Adjusted earnings per share rose 22% to $2.02, ahead of expectations. And free cash flow jumped 43% to $3 billion. Management then raised full-year guidance across the board, earnings per share to $7.65 to $7.85, up from $7.10 to $7.40, and free cash flow to roughly $9 billion. A beat, and a raise, on every major line. And the stock still fell. Hold that thought. If you're following where the power for all this comes from, subscribe. Next we turn to Vistra, the electricity play levered straight to the AI boom. Let's find where the money actually is. It's in one segment. Commercial Engines and Services, CES, did $9.7 billion in revenue, up 27%, at a 27% operating margin. Within it, services revenue grew 26%. That's the thesis in one number, the high margin, recurring business growing faster than the company itself. The defense side added $3.4 billion, up 16%, margin improving. But notice something in CES, revenue up 27%, and the margin actually down about 160 basis points. Growth is coming with cost, the first real tension in this story. Now the part that gets better with time, and it's counterintuitive. Total engine deliveries rose 26%, with widebody up 30%. Across the first half, LEAP deliveries are up 41%. And here's the twist, those early LEAP engines were sold cheap, even at a loss, to win the platform. But every one becomes a future stream of high-margin spare parts and shop visits for 30 years. And that switch is now flipping. LEAP shop visits are up more than 50%. The fleet GE seated at a loss is starting to pay. It helps that the main rival, Pratt & Whitney, spent years fighting durability problems, though Pratt is now certifying fixes, so that gift is narrowing. The loss leader was always an investment. It's just starting to earn. So who else makes these? Almost no one. It's one of the most exclusive clubs in industry. Building a modern jet engine takes decades of expertise and billions in investment, so the field is tiny. On large engines, GE and its CFM partner Safran, then Pratt & Whitney owned by RTX, and Rolls-Royce on the widebody side. That's essentially it. On the newest narrow-body jets, the highest volume aircraft in the world, it comes down to GE and CFM versus Pratt. Around them sit the suppliers we've covered, Howmet, which makes the superalloy blades, and HEICO, the cheaper replacement parts. But GE sits at the top of that chain. It owns the engine, and with it, the most valuable aftermarket in aviation. Now back to that 4% drop. Orders came in at $16.5 billion, up 17%. For almost any industrial that's a strong quarter, but against the previous quarter's 87%, it read like the supercycle cooling, and the market sold it. Here's what I think the market got wrong. Management's own framing was blunt: this is a supply problem, not a demand problem. Spare parts shipments they couldn't fill grew 20% from the prior quarter. That's not weak demand, that's demand they can't physically serve yet. And 4 days after that print, at the Farnborough Airshow, IndiGo signed a memorandum for more than 1,000 LEAP engines, the largest single LEAP order in CFM's history, plus a maintenance facility and a long-term parts agreement. Lumpy orders are not fading orders. Now the part that actually should worry you, the price. GE Aerospace has re-rated into a premium compounder, around $375 billion in market value, at roughly 48 times forward earnings. That is about 60% above the aerospace and defense industry median. On one side, the largest installed base on Earth, a services backlog near $170 billion, services growing 26%, a maturing LEAP fleet, and guidance raised again. On the other, 48 times earnings prices in years of flawless execution. Equipment is sold near break-even, so everything rides on the aftermarket. Margins are already compressing under supply costs, and in a travel downturn, the high-margin shop visits fall first. The franchise says exceptional. The valuation says you'd better keep flying. So where do I land? In my view, GE Aerospace is one of the highest quality industrial franchises in the world, and the market's reaction to that quarter was a misread. An order book swinging from +87 to +17 isn't a broken business, it's one whose customers order in decade-sized lumps, as Farnborough showed 4 days later. But the price demands respect, more than 3 months ago. At roughly 48 times forward earnings, not the 40 you might remember, you're paying in full for the annuity to compound, while margins compress under a supply chain that can't keep up. So the thing I'd watch isn't orders. It's whether GE can convert that backlog fast enough to hold its margin. I'd want this franchise, I'd rather own it when the cycle isn't priced for perfection. My base case for the next 12 to 18 months, services keep compounding, the LEAP fleet matures into a richer aftermarket, and the stock trades on whether supply catches up with demand. Watch 4 signals. First, CES margin. 27%, down 160 basis points. If growth keeps costing margin, a premium multiple gets harder to defend. Second, supply, not demand. Spare parts shipments they couldn't fill rose 20% in a quarter. Watch that fall, it's the best tell output is catching up. Third, services and shop visits. Services up 26%, LEAP shop visits up over 50%. A slowdown there is the real warning, not lumpy orders. Fourth, guidance and cash. Full-year earnings guidance was just raised to $765 to $785. Watch whether the raises keep coming. Upstream, GE depends on superalloys, castings, and a stretched supply chain. Downstream, it sits on the wing of much of the world's fleet. The catalyst that lifts it, supply catching up while the fleet flies longer. The one that breaks it, a travel downturn meeting a 48 times multiple. GE Aerospace sells jet engines cheaply, sometimes at a loss, to win 30 years of high-margin servicing on the largest installed base of engines on Earth. The engine is the razor, the aftermarket is the annuity. Last quarter it beat and raised, revenue up 21%, earnings up 22%, free cash flow up 43%, and the stock fell anyway, because orders cooled from plus 87% to plus 17%. Then Farnborough delivered a 1,000-engine order 4 days later. That's the lesson: judge this company on its services backlog, not its order headlines. The catch is the price, about 48 times earnings, and an air travel cycle the whole model rides on. This caps our aerospace arc. Howmet makes the blades, HEICO the cheaper parts, GE owns the engine and the annuity. One stock, all the numbers, no hype. I'm Big Z, follow me, see you in the next deep dive.